people are very discouraged by the metals and the miners. And I think that's exactly how bottoms are formed. Like I said, I think the bottom is behind us and we're starting to move out of that bottom.
This is Kaiser Johnson, and these are the Miles Franklin Weekly Specials for December 18th through December 25th, 2023, while supplies last. First, we feature 1 10th-ounce gold maples at just $30 over melt with a minimum order of 5. Next, we have silver eagles at $4.99 over spot, making this a great time to swap silver bars into silver eagles at the lowest premium in years. Finally, constitutional 90% silver is just $3 over spot per ounce. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.
Hey everyone, this is Elijah K. Johnson with Liberty in Finance. And back with us today is our good friend David Hunter. He has 50 years experience on Wall Street, and he's a contrarian macro strategist. David, thank you so much for joining us today.
Yeah, hi Elijah. Great to see you again.
Well, it's great to see you. Now, you've been talking about for a while this melt up that where essentially all markets, the stock market, metals markets, commodities, all of them rise at the same time, going to a parabolic top. Your perspective on this, because we've seen the Fed seemingly to be a bit dovish recently. The stock market has continued to go higher, and now we're hitting new all-time highs, which is really surprising a lot of people who were looking back at 2022, thinking that that was the beginning of the crash. But it seems like we might actually be in this melt-up that you've been talking about for a while. So can you expand on that?
Sure. Just to clarify, I actually use melt-up specifically for the U.S. equity markets. And the other things are part of the all-everything rally. But in terms of melt-up, it really is specific to the stock market. And the reason for that is because I think where we are in the overall big cycle, meaning I think we're at the end of a 41-year secular bull market in stocks. Commodities, gold, silver, etc., have another big cycle ahead after this one. So they're not in that same place. But yes, for sure, we're in the melt up for equities. I think it really started back at the end of October when the market bottomed down around 4,100. The S&P bottomed around 4,100. And we've been up almost 20%, I guess, since then. To do that in less than 2 months' time, and basically 6 or 7 weeks' time, that qualifies as the beginning of a melt-up. As you know, I'm looking for this rally to continue certainly into and probably through most of the first quarter. I have been using a 6,000 to 7,000 target for the S&P. Of late, I've been saying I'm pretty much dropping off that 6,000. I think 7,000 is looking ever more likely. And so I write a quarterly investment letter, so I'll officially probably change my targets in my January letter. But as of now, I mean, it looks to me like the top end of the S&P is probably very reachable. Top end of my target range there. And I'm going to have to raise my targets on the NASDAQ and the Dow and the Russell as well. So I think we're in a once in probably multiple generation type of move here. It's going to be fast and steep. I hear, and as you see, probably there's lots of people out there saying we're going to have a pullback. It's maybe a bit of wishful thinking because a lot of people miss this rally. You've seen some short covering. You've seen some people starting to adjust their portfolios. But the big reason why I've expected this is because in the last year and a half, you had so many people, basically the entire herd or the crowd, position themselves bearishly or defensively. And they were so sure that this market was a bear market, that the rallies we've had were bear market rallies. So they've stayed on the bearish side. And what you're going to see here, I think, and has begun, is a concentrated move back to the bullish side, meaning they have to adjust their portfolios by buying stocks. And I just think to do the size of the crowd that was on one side, everybody was on one side of the boat. When they all shift at once, I think we're going to find that basically you get a buying stampede. You find out how illiquid the market is when you have one-sided trades. So that's essentially why I think you're going to get this. It was helped along certainly by Powell's comments after the Fed meeting last week, where he indicated, more or less indicated that they're done. Doesn't mean they can't come back and tighten again, but at least for the next several months, I think the Fed is done. Now they're trying to walk it back a bit because unfortunately they've spent the last 2 years, certainly the last year and a half, overly focused on the stock market as part of their focus. Yes, they're looking at the jobs numbers. Yes, they're looking at inflation, but I think they were also buying into Bill Dudley's thesis that you had to get the stock market down to tighten financial conditions. And of course, we're seeing just the opposite. So every time the market lifted its head in 2022, out came, Fed officials to talk it back down. They kind of gave up on that this year because it wasn't working. Every time they tried it in early 2023, late 2022, early 23, the market would go higher. So finally, Powell, I think, realized, hey, this is futile to try to jaw bottom the market down. We just have to let that go. He would still be aware of it, but not as deliberate in terms of trying to jawbone it. But here with the runaway market after the meeting, you can see John Williams, obviously at the New York Fed, and a couple others have tried to talk it back down by saying, hey, I think the market is misreading what we said. We're still very vigilant, and we think we're done for now, but that doesn't mean we can't tighten again. And so they're trying to put some caution into the market. I don't think that's really what's going on here. I think the Fed is thinking everything is about that comment, Powell's comments. I think the market is picking up that the economy is slipping, that inflation is coming down towards their target pretty quickly now, and that the Fed has to let up on the tightening. So it's not so much their words anymore; it's really the streets picking up that we're at that point where the Fed doesn't have a choice. They're going to have to step back from tightening.
Now, you've mentioned before how this prediction of a melt up is coming from your analysis of really a 40-year trend. It's part of a longer trend. It's not like an abrupt prediction or anything like that. Can you expand on that?
Yeah, definitely for me, I've had this melt up forecast for a while. Now, I called the 2020-2021 market a melt up. That was a separate melt up. I mean, we don't usually get melt ups. They're something that come all around, very rarely. So to have two in such a short period of time can confuse people. But I think it is because of where we are late in both the secular bull market and also late in the super cycle, which I define a super cycle as that period, that long cycle between two depressions, in this case, 1930s, and what I think will be a depression in the 2030s. So we're in the last decade of a super cycle. So when you get to that stage in big cycles, things get a lot more volatile, and you can have these blow-off moves. So that's in essence what I think we're seeing. But yes, I've been talking about a melt-up long before last week's meeting, and I took a lot of grief in 2022 and early this year. And frankly, probably also this past fall when the market sold off, people thought it was a crazy call, and it is an extreme call. So I had a lot of people really questioning, that call and didn't believe it. It's only of late with this market moving back towards all-time highs that people are starting to jump on the bandwagon and say, hey, maybe you have something there. Maybe it is right. I don't think most people still believe that we can get to 6,000, never mind 7,000 on the S&P, but they are at least understanding that, yeah, this thing is now no longer a bear market. There's some legs to it.
There does seem to be legs to it with respect to the metals as well. How do you think they'll be reacting in the midst of this melt up in the stock market?
Yeah, I think metals and miners will be strong in the melt up. The miners will be among the leaders, I believe, in terms of performance. It's been slow getting started. It's been a very frustrating group for a number of years, but they have bottomed and they have turned up, and they're starting to come out of some of their bottoms now in a little more aggressive fashion. I think the next. I have said I think the metals and the miners will peak after the market. So if we get a peak in the market, let's say in March or April, you could carry the metals rally into the end of the second quarter, maybe even beyond that. My target for gold is 3,000, and that target is what I call a pre-bust target, because I am calling for a global bust to occur after this melt up. A gold bust and a big bear market to occur after the equity melt up. So I see gold going to 3,000 by, let's say, next summer or before. I see silver going to 60. That's been my target pre-bust. I actually have said of late we might even see get as high as 75. So I have a range of 60 to 75 there. Those are huge moves. And moves we haven't seen in, those would be all-time highs for both of those metals if we got there. But we also haven't had anything close to those kind of rallies since we had a very short one after the March lows during 2020. March to August, they ran aggressively. Before that, it was 2016. We had something similar to this. So it's been a while, and a lot of the so-called gold bugs have kind of walked away from the metal and said, forget it. It's frustrated me too many times. So I think we have the conditions now. It's very much ripe for that kind of a move. People are very discouraged by the metals and the miners. And I think that's exactly how bottoms are formed. Like I said, I think the bottom is behind us and we're starting to move out of that bottom.
It seems like we are seeing strength here in the metals markets, especially with gold really sustaining that $2,000 level. We dipped below it a bit, but after the huge rally we saw a couple weeks ago on the Sunday trading where we went above 2,100, does that give you confidence for the metals going forward, the recent price action?
Yeah, it's interesting. I talk about how they've not done well of late, but I'm really talking about silver because gold is not far off its all-time high. So yeah, gold is acting better than silver has over the last several years, but it's very close to it. It did break out, but it was a very momentary breakout and happened basically in the overnight markets and reversed itself immediately. So that caused people to think that was a top and gold was, giving you a final fake out to the upside and then reversing. I don't believe that at all. I think we had a breakout, but it wasn't ready to keep going. And now it's regrouped, and I think we are going to see new highs here very soon. And once it makes new highs, I think it's pretty clear sailing for the next several months. Silver obviously has a lot more overhead resistance to work through. It's nowhere near its highs of a few years ago. So that one is going to be, probably a little bit harder climb, but typically we find that when you're in a bull market for the metals, silver outperforms gold. So I think even though it's not going to run right to highs, it'll take many months, it is going to probably have better day-to-day outperformance or better performance in gold. Both will be up nicely, but silver will probably outperform.
When it comes to what happens after the melt up, I know you've said that there's going to be a huge crash. And I know a lot of analysts have been looking for that for a while, seeing stocks, they think they're overvalued right now. So what do you think this crash is going to look like once the melt up has finished?
Yeah, I don't typically use the word crash, but it is definitely, it'll fit that description because it's, I think, a peak to trough in the equity market, a peak to trough potential decline of 80%. We haven't had an 80% decline in the overall stock market since 1929 when it was down 90%. So that shows you how dramatic that is. And I think it comes because of an economic and financial bust, meaning an economy that's going to be in real trouble worldwide. This is global. And a financial crisis that I think will exceed the one in 2008-9, which means some big bank failures, more of those concentrated overseas. Europe's certainly a candidate, but so is Asia. So, Canada and Australia, their banks are more leveraged than ours now. We took our hit in 2008-9, and our banks got some religion forced on them to, recapitalize, make sure they have more capital or less leverage. So not that our banks aren't going to be suffering. I think there's less likelihood that we see our big banks go under. However, if it's as big a financial crisis as I think it's going to be, there's a lot of counterparty risk. So you can't rule out that, what's going to be hitting all the banking system is going to be hard enough to cause at least one or two over here, some, either close calls or having to be bailed out. So I think that's coming, the melt up first, because the tightening is over and people have to, run back into the market here, reposition. But probably by the second half of next year, we're in trouble because we are moving towards a recession. We're not in one right now, probably. But, we had a strong third quarter. Fourth quarter is not as strong, but it's still above water. I think as we move towards the middle of next year, we'll be in recession, and then that recession spills into something worse because of the leverage in the system. We have, as I like to say, we have 300 trillion, and it's now moved up to more like 320 trillion in global debt, debt across the globe. A lot of it's sovereign debt, but there's a lot of private debt. And then on top of that, we have quadrillions in notional value of derivatives, which is we're at levels in both debt and derivatives that we've never been at before. Even in 2008-9, we were high. We were at that time all-time highs, but this has gone another level above that. When you have that kind of leverage in the system, and then you have a hiccup or have a problem, it just exacerbates it. So that's why, very simply, we can have what I call a global bust, which we have not had a global bust in the post-World War II era. This is not just a recession. This is something worse.
Now, when it comes to this bust that we're talking about, one of the things that a lot of people look at is, how is this going to impact the conventional portfolio, right? The 60% stocks, 40% bonds. It would definitely have a negative impact on the stock portion. But what about the bond portion? In your perspective, how are bonds going to be reacting to this crash?
Yeah, that's a good question. I do believe we've seen the peak in rates, and that rates are going to be heading down. I think during this melt up, you could see the 10-year yield get down to, say, 2.5%. So there's still a ways to go on yields here. But when the bust hits, I think you're going to see 10-year yields all the way down to zero or below. And short rates, I think, for sure are going to go into negative territory. 30-year probably stays somewhat above, might be 0.5% or 0.25%. But I mean, those are levels below the levels we saw in 2020. So there's an awful lot of belief out there on Wall Street that we will never go back to those levels of rates, that we saw the secular low in rates, and that we're beginning a ratcheting up of rates over the next many years. I think there's one more all-time low in rates, one more lower low coming during the bust, simply because the economics of the bust are very negative. I mean, we're going to have a deep recession, hard landing, and coupled with a financial crisis, maybe the biggest in history. What that triggers, whether the central banks know it yet or not, and they don't, but when it hits, there's only one tool that can be put to work quickly enough to try to save a system that's free falling, and that is money. You will see money printed at rates even faster in 2020. My estimate is that the Fed will push out 20 trillion in the course of fighting the bust. So, between middle of this year and say middle of next year or the end of next year, I think you could see 20 trillion expansion in the balance sheet. We saw unheard of 5 trillion expansion back in 2020, 2021. So this is 4 times that. And that was so far off anything we'd ever seen in history. And then similar from all the central banks. And when I say proportionally similar, not the same numbers, but similar type magnitude of easing. And when you're doing that, when you're printing that much money, is QE, it's simply a case of buying the Treasury's bonds, buying from the dealer banks, and crediting them with cash. So they're getting new money into the system by buying up bonds. Well, if you're going to have to expand your balance sheet by 20 trillion, that's just seat of the pants estimate, but it's going to be an awful lot of bonds that are just being bought by the Fed. Never mind anybody else. Never mind institutions, insurance companies, banks, et cetera, hedge funds. So the demand for bonds during the bust is going to be through the roof. Now, I qualified the demand for Treasury bonds because you will see a separating of the two. Right now, both are moving together. Rates are coming down for corporate bonds. Rates are coming down for municipal bonds. Rates are coming down for Treasury bonds because the economy is still in okay shape. When you get into the bust, spreads are going to widen. That means you're going to see Treasury bonds rally a lot. Corporate bonds will probably be going the other direction. So your spreads are going to go through the roof. Corporate spreads now might be 3 or 4%, or junk spreads higher than that. They're probably going to go high double digits. So you will see very different treatment of Treasury bonds versus corporate bonds. It's going to be really important to be in the highest safety, highest quality bonds, which would be government guaranteed Treasury bonds. And so that will push, as I said, the 10-year down to zero, maybe below. When rates go down like that, what that means is the price is going up, obviously. So the value of Treasuries will be going up. And the shorter you go, the less bang you'll get, but you will see rates going down at the shorter end too. So all Treasuries across the curve will be appreciating. That will be, if you have those in your portfolio, they will probably be the only thing in your portfolio that's appreciating during the bust. All stocks are going to be going down big. Metals will probably be, they'll have their run, and then they'll probably be correcting pretty hard in the bust. So the one thing that I think will hold up, along with FDIC insured savings accounts, which I think they'll be, the FDIC will be given whatever funding it needs to satisfy the liabilities it has to cover. So if you have bank failures and your money is within the $250,000 FDIC threshold of insurance, you're protected. And I'm not worried about the FDIC not being able to meet their obligations. So that will be one asset that will hold value as FDIC insured accounts, and the other one will be Treasury bonds. And beyond that, I don't think there are a lot of things that you can look to that are going to be doing well in the bust. The bust is going to hit across the board: commodities, obviously energy, stocks, and corporate bonds. I think all will be hit.
If we look back at the beginning of this year, we saw a lot of bank failures due to Treasury bonds, the value of them going down, and then depositors asking for funds. So the banks had to liquidate the Treasury bonds at a lower value. Then they went bust or were taken over. In this coming crash, what do you think the problem in the banks is going to be if Treasury bonds are going to be doing great?
That's a great question. Yeah, the good news is that because rates are going to be coming down and their bond values are going to be going up, it won't be their balance sheet from the standpoint of their bond holdings. It'll be more their loan portfolios that'll be in trouble. There'll still be banks in trouble because they, got aggressive in lending to areas that are going to be hit. Junk bonds are going to be hit pretty hard. Corporates, if they have corporates on their balance sheet, they'll be hit. So it's the one area that everybody's worried about or has, saw the punishment last March, particularly, was the government guaranteed bonds, was the portfolio of treasuries that most banks have. Ironically, that's not where the problem is going to be when the bust hits. It's really their lending portfolios, and it's classic. You go back to 2008-9, go back to the early 2000s in recession, go back to 1974, early 1980s. Whenever a recession hits, and this will be a hard one, this will be a deep one, the banks take a hit because of their loan portfolios. And it includes mortgages. Housing is going to be a problem. So there'll be, particularly those that have bought houses in the last few years at these elevated prices. I think a lot of those are going to be, underwater, and if they lose their job, have trouble, maintaining their loan. So that's where you get into trouble, is when you have an economic cycle that turns south. The banks, obviously, their portfolios suffer. So the degree to which it happens, it all depends on the bank, and it depends, obviously, on the cycle. But because I think this is going to be a very hard landing, they're certainly going to have problems there. As I say, there'll be a lot of involuntary debt liquidation, I think, this cycle.
Well, it will be interesting to continue to track this with you, David, as it sounds like might continue to see this melt up in the stock market and a historic crash coming soon. If our viewers are interested in tracking this with you, where can they find you?
Yeah, I'm on Twitter every day. So at Dave H. Contrarian is my username there. And I tell people, just make sure you're following me. There are fake accounts out there that will look like, they'll have my profile picture. They might have a handle that looks very close to mine. So you have to be discerning and make sure. I have 195,000 followers. Most of the fake accounts will have, less than 1,000 followers, or won't have very many followers. So that's one way you can double check it. It seemingly has been less of a problem lately. There was a time when, every time I turned around, there was another person pretending to me and put out something silly that I didn't say. Anyway, at Dave H. Contrarian is my handle. I also do write a quarterly investment letter that is by subscription, so there's a fee to that. If anybody has interest in that, it's a longer form thing where I can obviously do more than what I can do in a tweet. So there's, my rationale and things are spelled out in my letters. That if people are interested in the letter or information on the letter, they can direct message me on Twitter, and I'll get right back to them with the information. Fantastic. Any last thoughts before we let you go, David? Just that I think you're going to have a lot of people out there opining day by day here. And most of them, I think, are still underestimating this market by a lot. Of course, it's had a tremendous run here in the last week and certainly the last couple months. So it's natural for people to assume it's time for a rest. So you're hearing lots of calls for pullbacks. Just be aware that this is a melt up. So it's not like every rally that we've had. It's not so easy to see pullbacks in these kind of things. You'll see, the market can correct 1 or 2 or 3% at any time, but 5 and 10% corrections, I think, are unlikely in a market like this. There's just too much money that has to be put to work in a short time, and the momentum it becomes FOMO. The more you get momentum, the more people feel they have to get on board. So I would just caution. Obviously, you can get pullbacks that are bigger, but I think waiting for those in this kind of market may prove to be frustrating. David Hunter, thank you so much for joining us today. Our viewers can find a link to your Twitter page in the description of this video. And thank you so much for your time. Merry Christmas and Happy New Year. Yeah, thanks, Elijah, for having me. And you and your family have a Merry Christmas.
This is Kaiser Johnson, and these are the Miles Franklin Weekly Specials for December 18th through December 25th, 2023, while supplies last. First, we feature 1 10th-ounce gold maples at just $30 over melt with a minimum order of 5. Next, we have silver eagles at $4.99 over spot. making this a great time to swap silver bars into silver eagles at the lowest premium in years. Finally, constitutional 90% silver is just $3 over spot per ounce. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.